And big tech is borrowing at record levels to fund its AI spend. The passive bond funds are snapping it up. Some investors warn the flood of new debt could rattle markets, especially with risk premiums already low as more highly rated tech bonds enter indexes. Corporate bond funds may start acting more like government bond funds, leaving everyday investors more exposed to interest rate swings.
And joining us to do that is Robert Schiffman, Bloomberg Intelligence Senior Credit Analyst. Robert, thanks so much for joining.
Thanks.
And I know that you've analyzed this debt coming from the tech power players and saying this is healthy, it's a healthy market, there's clearly demand. But what's the dichotomy between being people wanting to specifically buy this debt versus money that just needs to be put to work, really tight spreads, and limited supply at this moment?
Well, first off, bad news sells. So I think what we see is a tremendous amount of conversation about how the sky is falling. So I'm here to tell people that I don't see the sky falling. I'm looking up and it's clear blue, sunny skies. And for those bondholders out there that are worried, there are a lot of people like myself that got your back. And there's a lot of good reasons. And I think it's primarily all the data points that I've seen so far year to date that have worried some have made me feel better. I think an increase in capital spending highlights how much some of these companies see in future demand. Second, I see the amount that they're borrowing. Yes, leverage is going up a little bit, but I also see bondholder demand, record order books that we're seeing. Even for the problem childs, like the Oracle's $130 billion order book. We saw Alphabet earlier this week do a bond deal, $100 billion US book, and do a 100-year bond. What are we going to see next? Somebody issue a 500-year bond, a 1,000-year bond to prove that there's demand out there? So the last thing maybe is just fundamentals.
No one needs to prove there's demand, dude. I mean, of course, just look at spreads. They're tight across the curve, right? I mean, you can sell bonds if you have no credit rating or a great credit rating and not pay much more than treasuries.
Maybe so, but the reality is when we're talking about this debt deluge, we're talking about AA and AAA credits primarily. And that's where there's a tremendous amount of room. Why have such good balance sheets if you're not going to use them? You know, in the past, what did these companies do with all their excess cash? They gave it back to shareholders. What's the return of capital on that? It's absolutely zero. And if you think about buying back $100 billion worth of stock, if you're a $3 or $4 trillion company, does it really matter? I would much rather have them spend money on CapEx to drive future revenues and cash flows. If you look back, what was last year for all these hyperscalers and the Mag 7s? Record revenues, record EBITDA. What are we looking at consensus for this year? Record revenue, record EBITDA. And next year, and the year after. It makes a ton of sense to pour good money after opportunity.
What about this concern about just changing the dynamic of this bond market? That one of the pillars of keeping spreads tight has been limited supply. And all of a sudden, you're going to be rushed with a lot of supply, good or bad. It just creates more out there. And that in itself leaves us more vulnerable to a blowout in credit spreads.
Yeah, listen, that is a fantastic question. And I think there is a difference in fundamentals versus valuation. So fundamentals, obviously, I couldn't be more bullish. From a valuation perspective, you know, when we came into last year, we knew how big CapEx was going to be, at least in terms of a couple $1 trillion. We didn't know it was going to grow as fast as it did. And we had been suggesting that spreads, at least in high-grade tech, was going to widen out and underperform because of issuance. We saw that, but it was mild. And now high-grade tech bonds trade basically on top of the high-grade index, which is near its all-time tights. So could we see a little bit of weakness going forward if we see another record year of issuance? The answer is yes, but it's such mild issuance, and it is nothing in comparison to these massive type of equity vol moves that we're seeing. So I think if you start thinking about excess returns versus just mild spread widening, you can still see positive excess returns for these tech names, particularly as they're coming at concessions. And the one thing that I don't really worry about when it comes to big technicals and how big part of an index they're going to be, or are people going to be full? No one is ever full on anything if the price is right. So if you can offer bonds at a cheap enough concession, people are going to buy them. Maybe that causes a little bit of underperformance. But when thinking about the size of this market, the Bloomberg high-grade index is $7 trillion. Technology is about 10% of that. Net new issuance last year, it was a record of issuance, but net new issuance was only 60 billion. Let's say we break the record this year and there's 300 plus billion of high-grade tech bonds that are issued, and there's net new issuance of 150. Okay, so tech goes from 10% to 12%. That's not overloaded for anybody, particularly for the highest quality, and I keep saying it, Mount Rushmore credits of this market.
All right, great to get your take, Robert. Robert Schiffman from Bloomberg Intelligence watches tech credit for us.